Welcome, everyone, to this session in the ACMS. I'm honored to be with my colleague Mark Cheng and the speakers today. I'd like to introduce you to Mark. Mark launched the social finance program at Ashoka more than 10 years ago to help social entrepreneurs get investment ready and raise capital. Since then, he has helped more than 100 leading social innovation pioneers to raise more than 250 million in social investment. This decade of experience has been summarized in Mark's Social Investment Toolkit, which is available for free at socialinvestmenttoolkit.com. Mark and the social finance team, which I'm part of, have run 6 social investment accelerators and training programs for social entrepreneurs, including those sponsored by Boehringer Ingelheim with the Making More Health initiative, Nestle, UBS, the Belgian government, or Deutsche Bank. Mark, over to you. The online stage is yours.
Okay, great. Thank you so much, Alex, and welcome everyone. We've got a packed session here, so really appreciate everyone coming and joining us today for this exciting panel on impact investment. And the title of today's topic is Across the Spectrum, How Impact Investment Can Serve Both For-Profit and Non-Profit Entrepreneurs. And to address this topic, we have a star-studded panel of leading social entrepreneurs, impact investors, and advisors who have helped many Ashoka Fellows and social entrepreneurs raise significant amounts of capital for both for-profits and non-profits, and many different types of hybrid structures in between. So I'm looking forward to a great conversation around that today. Just to give you a bit of background on why we chose this topic. So the Ashoka network today is approaching 4,000 Ashoka Fellows around the world in nearly 95 countries. And what we've seen over the last few years has been a huge proliferation in different types of legal structures and entities that the Ashoka Fellows and social entrepreneurs around the world are employing. And at the same time, we've also seen an incredible boom in the rise of impact investment, investing in businesses and entities that create social impact. And one of the questions that we've seen at Ashoka, and we've discussed many times with many different organizations and types, is whether impact investment is only for for-profit businesses, or whether it can actually work with nonprofits and other organizations as well that sit in between. And we're very pleased to report that actually nonprofits have been very successful in raising impact investment as well. It is not simply a tool for profit-making businesses. That's one of the misconceptions, I think, that is often out there. But it's not been the experience of Ashoka, nor with many of our partners, that impact investment is limited only to for-profit making businesses. So we want to explore that today and discuss different routes by which entrepreneurs can access capital in different ways. I'm very pleased to be joined today and to be moderating this session with 3 colleagues from around the world. With Melissa Menke, who is the CEO and founder of Access Afia, which is a healthcare social enterprise operating in Nairobi. With Maurits Schutten, who is a distinguished philanthropist and impact investor and member of the Ashoka Support Network, who's been working with and mentoring many social entrepreneurs over the last decade. And with Marcus Freiburg, who is the co-founder of FASE, which is the finance agency for social entrepreneurship, which works with social entrepreneurs across Europe, helping them to develop social business models and to raise capital. So it's a terrific panel. I've had the privilege and the pleasure of working with each of our 3 panelists over many years on different projects, and I'm looking forward to a fascinating discussion with each of them. We're going to try and make this hour as interactive as possible. So we don't want simply just to have set speeches. The idea here is to be responsive to the questions which many of you will have in the audience, whether you are investors or whether you are corporate partners or entrepreneurs yourselves. I'm sure there's going to be a lot of questions and probably a lot of experience and wisdom as well from this peer group that we would love to tap into. So what I'm going to invite you to do is, as we have our conversation, as I speak to our panelists, please take advantage of the chat group facility on Swapcard and write questions as you go, or add comments as you go to what is being discussed. And my colleague Alex will curate those questions as we go, and there will be plenty of opportunity to bring Alex in to share with us the questions so that our panelists can respond to those questions. So please feel free to make this as interactive as possible. We would love to hear your questions, and we'd also like to get your reactions as well to what people say. So that's a little bit of background on the topic and why we're putting this topic forward today. I'd like to open by inviting Melissa from Access Sophia to share a little bit about your experience, Melissa, as a social entrepreneur who has raised both grants and impact investment, which is quite unusual, I think, and to learn a little bit more about your experience in doing so. And Melissa, perhaps we can begin. Maybe you could share a little bit about what Access Sophia is, what you do, and what the mission is, and then we'll talk a little bit about how you launched Access Sophia from a legal perspective, because you didn't go the nonprofit route. You've gone an interesting hybrid route, which we'd like to talk a bit more about. But Melissa, perhaps you could just quickly open by sharing us a little bit about your organization and the work that you do.
Yeah, absolutely. So I'm Melissa, the founder of Access Sophia. We are a primary healthcare organization operating in Nairobi, Kenya. And we have a comprehensive model for care that combines low cost and very lightweight micro clinics. So listening from the US, this could be like a CVS Minute Clinic for Kenyan slums. So just kind of a one-stop shop with access to rapid and digital diagnostics, highly controlled interactions with clinical officers, and over 400 different types of medication, health, and hygiene products available on site. To complement this, we've built out a virtual clinic called mDoctari. So between visits or before coming to a clinic, people can call in, get good quality advice, consultations, and even digitally distributed prescriptions to follow up with that. So the business model is combining a fee-for-service model. So essentially saying that Access Sophia's even ultra low income patients living in informal settlements oftentimes have to pay for healthcare anyways. They do this because public health facilities are either unavailable or out of medication or unable to provide the lab tests that they need. So we make things easier by being able to come to one place for everything instead of run around, with an actual model that is based on licensing. So this year we've launched a franchise business and are growing the business through onboarding franchisees. So I'll just give a couple of comments, Mark, and we can dive deeper into any of them. Especially this year, we have raised completely across the spectrum. So very, very, very relevant. I'd say that the most philanthropic capital we have is we've distributed about $125,000 this year directly into the pockets of our patients. So this isn't even funding the business. We're just, in spite of COVID and people losing jobs, we can receive funding, and we've got a database and we know exactly who is pregnant. We have an idea of who is in sort of like the highest risk areas we work based on neighborhood location. We know who has monthly healthcare costs because of hypertension. And so we can help other organizations identify people who are high risk and get resources to them. So that's been an interesting model that is actually brand new this year because of the pandemic. We then, as an entity, have raised philanthropic capital for ourselves. I think our biggest strategic partner here has been Ashoka and Boehringer Ingelheim through this Making More Health coalition. And we can dive into a bit more detail on how that worked, but at a high level, when we brought projects kind of to life through that partnership, it tended to be things that needed like an R&D lab anyways. And so that's where philanthropy played a huge role, is we would say, actually, you know what, our clinics can manage diabetes and we can manage it, you know, at a profit margin. But the problem with diabetes in Kenya is that most people don't know they have it. And actually, our data later told us that 80% of people who we diagnosed had no idea that they were at risk for this. So Boehringer helped us pilot an innovative screening model so that we could actually drive more traffic. This was philanthropically funded, an innovative conversion model, so using a combination of behavioral messaging and tips and tricks to get people to move from screening into clinics. And a lot of the monitoring and evaluation around the outcomes. So we've structured a couple of things like that, but I think that was a really great example of how we've used philanthropy. It's not sort of sitting side by side investment. It tends to be ring fenced to solve a particular problem that we can't really solve with investment capital. Yeah, and then I think on the other side of it, we have both impact-focused investors and a couple of investors who just see the scalability of what we're creating and the size of the market and don't necessarily identify as impact-oriented, but have also come in as early stage investors to Access Afia.
Thank you. And I think one of the really interesting things that you mentioned there is that you have ring-fenced the sort of the projects that you allocate philanthropy towards, and you know, and then the activity to which you drive investment. And I think that's a very interesting principle to bring out from your work. One thing I just want to dive a little bit more into is could you just explain what is the legal structure of Access Afia? Because it's not a non-profit, as I understand it. Is that correct?
Right. No, exactly. So I've incorporated it as a public benefit corporation, which is a really interesting legal structure because it enables us to do two really important things. Number one, it was created so that you can hold a management team accountable to creating stakeholder value in addition to shareholder value. So you sort of hear these horror stories of CEOs being taken to court for paying people above minimum wage or whatever. And so we've actually been able to kind of create statements of public benefit, creating access to quality healthcare for underserved markets, and creating hyper-local jobs, so prioritizing hiring in our communities. So there's a couple of elements of stakeholder value and actually having a legal entity that says, you know, it is a for-profit structure, but we are trying to do two things here, shareholders and stakeholders. The second thing it does, to be perfectly honest, is it's a signaling tool. So it actually shows people we buy into the idea of benefit corporations and PBCs. We think it's important for people to know this. And so it helps us find the right types of investors. And so that's been really useful for us as well. So then a public benefit corporation sits in sort of US law, and then that owns a Kenyan limited company, which is also a company which does all of our operations. A couple of the grants we've raised do have to then flow through a third party, you know, if there is a 501c3 requirement. So we do have a partner for that can help, you know, accept the funding, understand the project, disperse it to us on a pre-agreed timeline with the donor, and make sure that all of the sort of reporting and tax compliance works for the donor.
Fantastic. And just to clarify for our audience, benefit corporation is not the same thing as a B Corp, right? So benefit corporation is a specific US legal form, which, as I understand it, is kind of, it's a for-profit, but it's one that has a sort of social regulation as well. You have a clear social mission. And I think you have some restrictions on dividends as well. Is that correct?
Yeah, and also on, so putting, the restrictions are a higher number of shareholders would have to approve. So certain things get kicked up from majority to 2/3. And so this would be certain types of payouts and acquisitions and yeah, pretty much those.
Okay, great. And I just wanted to dive into two questions before I bring in the investors into this panel and get their take on things. But one thing I'm very curious about is you set up Access Afia, I think it was about 8 years ago now, right? And presumably when you did, at that time, you didn't know whether you were going to be predominantly a business-driven model or an NGO type model. How did you come to decide which choice to make? You know, whether you were going to be an NGO? That must have been quite tempting for you to be an NGO from the beginning because you were raising grants at the beginning, right? So I'm just curious in whether that was what was the thought process behind you choosing to be a benefit corp, and secondly, are you happy with that choice 8 years later? And or has it created challenges for you in terms of your ability to raise investment? Maybe you could just comment a little bit about, has it restricted you or has it enabled you in your mission?
So, it actually happened in a slightly different order. So I was actually studying, business and social business, and became really interested in this idea of replacing informal chemists. So saying there exists an informal healthcare delivery system. People are spending loads of money there. These are not run by NGOs. They're not being propped up by USAID grants. And so we could have a really compelling business model if we can simply shift people's spending patterns from the informal sector to the formal sector. So for me, it never even crossed my mind to start an NGO. Because for me, it was really seeing that opportunity that excited me. And actually, the very first person I kind of convinced to believe in the concept was an investor who is only an investor and would not have been a donor to an NGO. So it felt really straightforward to kind of put two and two together. Here's the opportunity I see in my background, in my beliefs, and then the initial capital being a convertible note. So we started as a business, but then I will say, the first year or two, we were then able to kind of win a bunch of prize grants because it was a new idea, and there's a lot of seed money out there for people who want to try something new, and those initial grants never had an issue coming into a business because it was kind of part of the time, I guess. People were sort of, Kenya was turning into a lower middle income country instead of a low income country. People were thinking about, big donors exiting the market. There was an emphasis on sustainability. And so it just didn't come up for about 2 years. I would say sort of, 3 to 4 years in is when I started to kind of rethink structure and actually say, what we're too mature for the price, for the kind of new idea prizes, but we have an idea and it works, and we see traction, and the first clinic, we can get it sustainable, and now we need to start to do early expansion, and you're just nowhere near where the commercial funds want you. You're nowhere near sort of the annual revenue targets. You're nowhere near the sort of like maturity of sort of senior level hires in your team, and to actually kind of build that out to be something that is more commercially investable. You need more money and you need more time. And so I think that's one thing that I potentially would have done differently, is potentially set up more of a hybrid structure, which you see a lot of companies in Kenya do, where you can have somebody else kind of running your NGO and raising money and focusing on sort of solving problems that you haven't quite figured out, but also finding more like longer term and strategic funders. Not just sort of based on 6 to 12 month milestones, but kind of looking at what do we need to create over the next 2 years. And then combining that with sort of like the nimble enterprise that is just focused on the business model of the micro clinics and virtual clinic themselves. So I haven't changed structure in response to that. We've somehow sort of powered through. We have, like I said, a partner who can accept grants, but it is something that I've seen others do, and I would advise somebody else to do it. I would advise the younger me to have set something like that up, to make that sort of what they call the valley of death, I guess, easier to cross.
And when you say, so your advice would be consider going for an NGO as well as a for-profit and have some kind of link between the two. That's a very common route that I think a lot of entrepreneurs take up.
Yeah, I mean, I think especially, I see a lot of impactful businesses that sort of know the size of their market and how they're going to scale with commercial capital from day one, and then maybe they don't need it. But I think for some of these models like Access Afia, where you're really going like deep into the base of the pyramid, into areas that are slightly more complex to scale, because there is an element of, differences between the different counties in Kenya and the different languages and the different sort of cultures, even within the same country, that have to be adapted to make a healthcare model successful. And I think that there's been at least one other healthcare company here, Jacaranda, that's done that. Sanergy and Waste Management has done that. And I think these businesses that are going sort of very deep into models that aren't just sort of, out of the box going to work everywhere they're downloaded. I think that really helps you build something that is, authentic. And, and like I said, it really helps you at that stage from, I would have never called my business a pilot. It was always a business, but you're still proving your concept the first year or two. And we had a few years in between that and being ready to raise larger growth capital. And it was really hard to know where to turn during that time.
I think that's a very common experience, and you mentioned the valley of death, and this is something which certainly at Ashoka we spend a lot of time trying to help our entrepreneurs and fellows get through, because there's no question there is this moment when you're usually about 3, 5, 6 years in, where you're halfway between what philanthropy and startup grants can do for you and what you need from growth capital, which comes from investors. But then they're looking for a level of growth which you don't offer or you don't have because you are a socially mission-driven business, and because your cost base is therefore different. And so many of our clients have struggled with this and are working out different ways of doing it. And and Marcus has a lot of experience on this, and would love to, Marcus, would love to bring you in on this. But it seems that what most of them are doing, as I understand it, is finding ways to blend philanthropy and investment. So rather than saying it's either or and you must choose one, it's how can you creatively find ways to unlock both for the same organization. And whether you do that by splitting the organization into an NGO and a for-profit, or whether you do it in the way that you've done it by having specific projects that could be donor funded and other specific activities that could be investor funded. I think that's a really interesting sort of set of tools that I'd love to dig more into and explore. But at this point, I'd just like to maybe bring in Maurits as our impact investor. So Maurits, you've been investing for many years, and you've also been a grant maker as well. I'd love to ask you, how do you see your philanthropy and your impact investment? Do you see them as separate and distinct, and that you, as an investor, adopt different hats for those different activities, or do you see them in an integrated way? And how would you view an organization like Melissa's, Access Sophia, which actually does both, which raises grants and investment? And would that cause major issues for you, or are you comfortable with the idea of an organization that can do both?
Yes, well, lots of questions in one go. I would say, so my journey actually started when I joined the Ashoka Support Network 7 years ago, and I met you, and then started seriously into impact investing. So it's all like very inspired by Ashoka, so very much looking for scalable solutions, for potential for system change, and always like having this idea about scalability and efficiency in the back of the mind. And I would say that is both on the philanthropy side and on the investment side. So my background is in finance, so I do feel a little bit more comfortable with impact investing. There, I feel I can bring more to the table. I like the idea that an organization that's investable obviously has to have the revenues to pay back the investors, and also to build a sustainable business. That, I think, creates a certain discipline and flexibility and mindset that appeals to me. So therefore, I have a slight preference for impact investing. But we see a lot of the organizations we have a mix. I mean, here in the Netherlands, there are actually lots of different instruments which are really a combination of investing and philanthropy. And I mean, I suppose the most obvious one, and we do quite a bit, is this concessionary investing. So we give a loan where the interest rate is clearly lower than it would be on commercial terms. And we're quite happy with that, because we feel like this is probably the only way to achieve the impact. And we get a lower return, but instead of that, we get the impact. And to a little bit what Melissa is saying, we've seen a fair amount of companies that are I mean, commercial in a sense, but they get paid for projects. And these projects you can almost see as grants, so it's very grant linked type. So that obviously fits very easily into a commercial setup company.
I see. And have you ever made a grant and an investment into the same organization? Is that something which you would consider doing, or do you think that they're fundamentally opposed if it was the same client that was raising both?
Well, I mean, the concessionary loan is, in a way, is that, right? So you're basically subsidizing the interest rate. I haven't done that where I literally did both an investment and a subsidy. No. Okay.
And you say you're making loans, but what would your attitude to the investee be if the social enterprise defaulted on the loan? You know, in other words, I think it's a bit of a challenge for many impact investors as to what they would actually do in a default scenario. Do you actually wind up the company and you know, you're doing this for mission, you're doing this for impact, but obviously, you know, not every investment is going to succeed. What is your attitude in response to this, or is it really a grant that's going to, you know, you would write off in a difficult situation?
So I mean, so I look at this as regular investing with kind of a boost, I suppose. So with all the investments we make, we clearly, it goes through our mind that a lot of the money won't be paid back, which is the same with regular investing. So you make loans, you buy equity, and sometimes companies don't make it. I think the nice thing about the impact investing side is that even if the money is lost, then at least you hopefully have made impact, or you open some kind of road, or I mean, in many different ways you can make impact. And yeah, and if you do a commercial investment and the money is gone, it's just the money that's gone, right? So I think that is kind of an added benefit from impact investing. And also I feel that around impact investing, if you look at the other investors or grant givers, there's a lot more goodwill around making the company a success. So I think that this whole idea of pulling out the plug just because they can't pay an interest or some coupon or something, it's a completely different process. And we certainly haven't had any situations where we forced for bankruptcy or anything like that.
Right.
But maybe a little sidestep here is that, so in the Netherlands, there is an institution that basically gives out grants, and they say that if the company is really successful, we turn it into a loan. So that's also kind of an interesting way of looking at this whole concept.
And that kind of hybrid instrument is something which we're seeing more and more of, which I think is really exciting. Actually, it is, you know, that there's now a lot of innovation. Specifically in the impact space, around new ways to create capital that's more entrepreneur friendly and more impact friendly. And this actually might be a great moment to bring in Marcus, whose organization works with a lot of these types of instruments, you know, finding creative ways to help entrepreneurs, social entrepreneurs to raise more capital. Marcus, could you share a little bit more about the work of Farse and also the kind of clients that you work with? Because I know that you do a lot of work with them across the spectrum, NGOs as well as for-profits. And tell us a little bit about the background that you've seen with the clients that you work with.
Yeah, thanks a lot, Mark. Happy to do so. So actually, Farse, we started in 2013 together with Ashoka in Germany. And we basically set up Farse as a corporate finance advisor that supports Ashoka fellows and other social enterprises in raising hybrid growth capital, and really tries to build bridges between let's say impact investors and philanthropists and social enterprises, and really support those Ashoka fellows through the whole funding cycle. So starting from the initial, let's say, review of the business model and the impact model, but then also structuring the deal with bringing different, let's say, financing elements together. So equity, mezzanine, but also blending in grant elements, and then actually approaching a network of impact-oriented investors, and usually then building coalitions of, let's say, 2 to 5 investors that can support the Ashoka fellow both financially and non-financially, and help them to structure the deal and close the round. And in the last 6 years, we supported more than 50 financing rounds successfully in raising more than 25 million euros, And that's really, let's say, the core of our activities as a corporate finance advisor. And just recently, we also launched a second pillar with FASA and launched a new co-investment facility, the European Social Innovation and Impact Fund. So it's a matching facility with a target volume of 20 million euros. And the idea is that the fund can invest alongside direct investors into Ashoka Fellows and other social enterprises based in Europe. And that's actually the first mezzanine fund across Europe that is making use of guarantees from the European Commission. And we hope that with this, we can actually help to significantly, let's say, bridge the gap, especially in the early phases. So that maybe for the first question regarding our activities. And regarding the second question, that the type of social enterprises we are working with, it's indeed that we see many social enterprises that operate across the returns spectrum and that really operate hybrid models. So it's really very often a combination of for-profit and not-for-profit elements. And it's really, let's say, showing that this, let's say, black and white division of the world in just for-profit and not-for-profit, I think that is not appropriate. And we see that many Ashoka Fellows are mixing these elements. And that is also often reflected then in the organizational structure. So we often see that there is a for-profit structure together with a not-for-profit structure. And the not-for-profit can be the mother company, or it can be a sister company. So that is really, let's say, can differ between individual Ashoka Fellows. But I think the strength is really to set up a structure that is both applicable for the philanthropic side of the capital, but also for the, let's say, impact first part of the investor market.
Can you just share with us sort of what proportion of your clients are non-profits versus for-profit, and how many roughly set up this kind of dual structure which you described?
Well, I have to say that maybe let's start from the type of financing that we do. So usually I would say the hybrid financing that is more focused on mezzanine structures, because they are not exit oriented, on more, let's say, hybrid organizations. That's potentially 2/3 of our clients, maybe 50% of the volume. And then the other, let's say, 1/3 of the clients, maybe 50% of the volume, is more like technically profit with purpose structures that operate with a classical equity structure. Regarding the hybrid settings, I have to say that especially among Ashoka Fellows, we often see this hybrid structures, where it's then really a sister company, or the not-for-profit is the mother company. Regarding the investment, I would say that actually, technically, the impact investment often goes into the for-profit entity, because that is often then, let's say, providing the products and services at the market. And the philanthropic funding potentially goes then in the not-for-profit entity. So I would say technically the impact raise for a not-for-profit we have also done, but this is only, let's say, very few cases. In the majority of the hybrid cases, the investment goes into the for-profit entity. Okay,
thank you. And I'd maybe I'd love to ask each of you actually, but especially Marcus and Melissa, about how you deal with or advise your clients in dealing with potential conflicts between different types of investors. So where you've got one organization that's raising grants and you've got another, and the same organization is raising investment, one of the sort of classic conflicts that we see all the time is the donors being uncomfortable with the idea that somebody else is profiteering from the investment and they are not, or they're putting in money for free, and somebody else is making a financial return on that. That's one conflict that we've often seen. And at the same time, the investors, often tell us, well, they're not really comfortable with a model where an organization is dependent on grants. Right, because that means that it's not sustainable, necessarily self-sustaining as defined by financial advisors, right? In that sense, and this is something which many fellows that I've known have really wrestled with, and in some cases have had quite serious conflicts between donors and investors. And Melissa, I think you hinted earlier that you solved this by trying to find very discrete projects to channel the investment or to channel the donations. I'm just curious, Melissa, maybe you could speak to have you had an experience of a conflict between investors, and what kind of strategies do you adopt to try and deal with those, if any?
Yeah, definitely. I'll share, and I'd love to hear from Marcus or others how it works on the other side, because I guess, to be honest, what you're saying resonates 100%, and that's a lot of the feedback that I would get in the pitches. And so usually, like, kind of post closing, we don't tend to have these big conflicts come up, because people have either sort of dropped off because of that discomfort, or we've worked through it. But yeah, I mean, I think one of the hardest things about trying to run a hybrid structure is when you are talking to donors, like, there's still, you go to Ashoka's conferences, you go to Skull World Forum, you go to SANCALP, you go to SOCAP, and everyone's talking about blended capital, and everyone's talking about patient capital, and everyone's talking about hybrid structures. And yet when it actually comes down to doing it, I do think that there is that feeling where donors don't want to feel like a fast one is being pulled on them. Like, you structure this as a business, why do you need me? And investors don't want to feel like you're going to be distracted, chasing grants instead of driving revenue. So I guess that's not particularly helpful, but I have to say it does completely resonate. I guess, in addition to trying to say the donors help us with a new thing or a tough thing, I've really tried to also, like, have a crystal clear strategy and set of targets that we want to do anyways. And so you're not necessarily tweaking the pitch. I mean, I think a couple years ago, one of the mistakes we made is you sort of take that idea of a special project too far. So diabetes, hypertension, we wanted to do that anyways. There's a huge opportunity there for us. But sometimes you'll kind of see these challenge funds and you're like, oh, well, we can intersect with that challenge in this way. And so then you're kind of thinking like, oh, we could also be this, but kind of at the sake of that. And that can bring capital in, but I think that's where the conflicts can really come in, is if all of a sudden you've sort of promised some extra KPIs that are outside of your organization's roadmap to a particular donor. And so we've made that mistake. Even one time we had to go back and talk to the donor afterwards and say, we hadn't even spent $1 yet. We're like, we shouldn't have said this to you, a year ago. We're not going to be able to deliver on it this year. And it took us a long time to kind of renegotiate how those funds were then eventually used. So I think that the other takeaway is, in as much as a special project, unlocking a new insight really helps, you can't take that logic too far and sign up for things that you didn't say you were going to do when you wrote to your investors and presented your January strategy.
Thank you. Yeah, no, I think that's good advice, and we've certainly seen a lot of people chasing the grants and then having a new set of KPIs for every donor that's coming up. Alex tells me there's some great questions coming through on swap cards. So Alex, maybe I could hand over to you just to share with us a little bit about what the audience is thinking and saying, and maybe share with us 1 or 2 questions.
Thanks, Mark. Yeah, it's difficult to pick the questions that are relevant because all of them are. I'd like to bring one question to the conversation from Rosa Ricucci. So Rosa's asking how we could close the gap between the philanthropic approach and the impact investing approach, understanding that should philanthropists care more about financial sustainability even if they are not receiving financial returns? And should impact investors focus more on the deep social impact instead of measuring impact only in terms of very direct services, which is something that happens quite a lot. And she's having this reflection. It would be great if we could learn from one another. Okay,
fantastic. Marcus, that sounds like a question that might be great for you. Maybe you could speak to, how can we help bring the philanthropists and the impact investors together? And I know you have some great examples here from your own work. So what are your thoughts on that gap? How to close that gap?
No, happy to do so. And I think it also, let's say, correlates to the point that Melissa shared before. So really how you can establish structures to bring philanthropists and impact investors together, because obviously I think that creates complexity. And I think it's key to be really, let's say, explicit also in terms of expectation management and to understand let's say the requirements from each individual side. and then to come up with a structure that, let's say, adheres to the specific requirements of the individual, let's say, either philanthropic grant givers or the investors. Because I think what is difficult if you bring, let's say, the same type of capital, different types of capital for the same thing. So I think you need to define specific roles. And maybe just to share one example from our work, we in spring supported the Dutch Ashoka fellow Jos van Engen, healthy entrepreneurs, in putting a round together. And they're doing last mile health delivery services in Uganda and Kenya. And it was a hybrid round of a total of 2.5 million. And on the one hand side, for the grants, they obtained funding, 1 million funding from the Dutch postcode lottery. And it was clear that this philanthropic funding was used to train health workers in Africa and, let's say, integrate them into the model. And on the other side, we helped them to structure an investment round of 1.5 million. It was actually split between junior and senior investors. On the junior side, we brought in, let's say, business angels and equity type of investors that were really, let's say, willing to take the equity risk and support healthy entrepreneurs going forward. And then that was also combined with a senior loan from a Dutch co-investment facility called the Dutch Good Growth Fund. And for them, it was important that they had a senior position and were first in the waterfall, because as they mentioned, that it was their first actually a hybrid social enterprise that they financed that had a significant ongoing part of revenues from the grant side. And I think that it was needed to have the additional security from the equity investors to give them the comfort to move forward. So I think it shows that if you really deep dive into the specific needs of the individual, let's say, financiers, it's possible to come up with a structure, but it is connected with some, let's say, transaction costs. And I think this is really important to build the bridges in especially the early growth phases of a social enterprise to bridge the death valley and to come to a workable solution for each and everybody.
Thank you. And just one thing I'd add to that as well. I fully agree with what you're saying. I would also suggest that one of the things that we've seen at Ashoka with the capital raising as well is philanthropists are often very happy to play the role of R&D and early stage development. So they'll take the risks on pilots and developing prototypes for the entrepreneurs. But at a certain point, if the conversation is handled well, the philanthropist should be happy to hand over to impact investors who are willing to put more capital into the growth phase of the organization. But I think there's quite an art to having that conversation handled skillfully and early, so that there's no misconceptions, right, about what the role of philanthropist is and what the role of the impact investor is. Very crudely, philanthropist to help seed the organization, help it prototype, and impact investment to help it scale. But then this handover in the middle is, I think, where the challenge is, right? And there are good ways and there are bad ways of doing this. So
no, absolutely. So I think it's really about the different roles that people can play, and I think usually you perceive it that at the beginning of an organization you have, let's say, the grant funding and to grow something. But I think it can also occur in later phases where there might already be some impact investing to scale up some part of the business model. Then the social enterprise might, let's say, prototype and develop new things where they then can bring in grant funding again. And then even in later rounds, you could have, let's say, a blending. Yeah,
absolutely. Alex, any further questions from our audience?
One difficult question. I personally think, but it's a good question raised by Thomas Blettery. So Thomas is asking, how can impact investor can contribute to explore new ways of funding the seemingly non-fundable deep roots of the problems that social entrepreneurs are tackling, in addition to funding the solutions that are addressing the symptoms? Obviously, both are needed.
I see. Any on our panel, I think would be interesting to hear from on this one. So it's an absolutely classic problem, right? I mean, there are some social issues that just don't lend themselves to profitable businesses generally, and therefore how some parts of education. I think this is a very classic example. Also, reaching out to certain marginalized groups that don't have funds, essentially, so they can't be customers. How can impact investment or social capital of any kind reach those kinds of social issues without, finding some kind of funding model, essentially, to make that happen? I'd be curious in anyone's thoughts on this. I mean, Melissa, in many ways, I mean, you're actually already doing this. I mean, you're addressing healthcare in slums, and that traditionally would have been an area that most people would have thought about and said, there's no way that you have any kind of customer base there. So how are you able to square this circle of actually creating a business out of something which doesn't look like there's naturally a clientele, right, or a customer base? I mean, is that a misperception of the market, or is there some kind of secret to how do you unlock even the base of the pyramid?
You know, I'd kind of say there's a few levels of this I'm thinking through, and you know, in a really direct way, one of the things that, you know, I've been preaching about for 8 years is, like, people in slums pay a lot for basic services. They pay for healthcare anyways, not because of Access Afia. They pay to use the toilet. They pay to get water to wash their hands. Like this, they pay, you know, for all the essential services. Private schools exist despite the fact that there's, you know, quote unquote free primary education. So I 100% think that in some cases, there are just misconceptions on how these markets work, because there's an assumption that people in poverty are not going to be able to afford things, and there is an opportunity to create these micro margin mass scale businesses. I do sort of sympathize with the person asking this question, because I think we've also come across it a couple of times as well, where, you know, you look to take your work one step further and you can't quite fit it into the investment narrative. So I guess I would sort of think about two things. And actually Ashoka's systems change methodology helped inform this quite a bit. I would echo what Mark says. Not every social problem necessarily needs a business to fix it. You know, sometimes you need a movement, sometimes you need a pledge, sometimes you need, you know, there are other tools, and some of those are not investable. And then it's really just about understanding that sort of 10-year vision of success. And if that is, you know what, we've got to work through all the slog to get to a profitable business, then the tactics we're talking about today will help you. And if the 10-year vision of success is just that, you know, everybody has agreed to give 10% of their corporate profits to you know, to education or feeding programs, then maybe you don't actually want an investor. Maybe you do actually want, you know, a philanthropic partner who understands that vision. And I would kind of say that the last sort of comment on that we thought about with root causes, as Mark knows really well, we've been thinking through a structure called Access Afia Labs, which can actually take some of that root cause work out of the business, and that would be the sort of cornerstone of our hybrid structure. So really sort of solidifying that sometimes these things are hard. I mean, we don't want to just help patients manage hypertension. We want to prevent it, which is essentially running weight loss programs, and that's really hard to get people to pay for in the settlements we work in. But that's a great labs concept. That could be a business that might be a public health campaign. That one needs a bit more fleshing out, you know. And so we have a couple of ideas that are in that, you know, this needs a bit more work before we can actually put it as part of the commercial strategy.
Right. Yeah. Marcus or Moritz, what are your views on this? Is impact investment simply a hammer looking for, you know, for a nail and applying, you know, a one-size-fits-all approach to solving social problems, or do we need a very nuanced approach where it's only suitable for a subset of issues, and perhaps root cause issues are less amenable to this kind of approach?
Well, I would still say it's difficult to invest in something if there are no revenues, right? So it has to come from something, and so you have to be creative. And so I think one way of doing that, of causing or solving these root problems is making it a lot more efficient or easy to tackle these problems. And what I'm thinking about right now is, for instance, if you look at the large multinational companies, there's a lot of pressure on them to look at their supply chains, that everything's clean there. and that it's regulation, it's social pressure. So there's, for instance, one company we invested in that really looks at the worker circumstances in the supply chains, in factories and etc. And they made that very efficient for companies to do that. And the companies are kind of pressured to do that. So the business model then basically becomes that the large multinational companies are paying for this. And they can work with the workers and the factories to improve their living conditions and make sure people are not exploited. There's no slavery. There's no child labor. And I'm thinking about another company right now, which is an Ashoka Fellow that is raising funds at the moment, Scope Insight, where FAS is also working on. Again, you're looking at supply chains of agriculture businesses. And what Lucas is trying to do is to help these businesses to become much more professional. And obviously it makes the companies investable, but also improve the supply chain for the multinational. So it's kind of in our impact investing, we're more and more looking at these B2B type of solutions, where the large companies, you basically help the large companies to fulfill their one side efficiency, but also to reach their goals in terms of climate and social goals. You make that easier, you get paid for that. And I think through that way, you actually, you do change systems, and in many ways you help the bottom of the pyramid.
Okay, fantastic. Marcus, any thoughts on this?
No, I would fully agree. And also how we discuss with our clients is really that we see impact investing as an element in the toolbox to finance further growth and the scale up of the impact of a social enterprise. But obviously, it's not the right solution for each and everybody. And we're also not saying that just with a business-driven, let's say, business model is the right one for each and everybody. So it really is an individual question and needs to be customized to what level I think, let's say, philanthropic funding and impact funding can be used. We just want to encourage Ashoka Fellows to think also in those dimensions, to use it to scale up their business. I think that's one point. I think the other point, I think that is also concerning us a bit, is that we sometimes see, let's say, too high expectations from the impact investing world. So we see actually that many investors are looking for, let's say, saving the world and beating the market. And that is, I think, a very difficult proposition because we see that there are actually quite a few trade-offs, and we don't believe that you can, let's say, achieve over returns in let's say, solving the most challenging problems that we face around the world. So I think that we are a firm believer in the full return spectrum of impact investing. I think that we just need to be cautious as a sector that we don't create, let's say, over expectations that we can then in the end not deliver. Because we actually see that quite a few investors are waiting at the end of the pipeline and really looking only for this very, let's say, high return opportunities. And what we think is lacking is really, let's say, the development of an early pipeline early on to provide the social entrepreneurs the patient growth capital to develop and scale their models.
Okay, fantastic. Thank you. I see that we're in our final 5 minutes. So I'd like to really bring this wonderful discussion to a close. And what I was thinking was, I mean, we're having this conversation in November 2020, in the middle of the second wave of the COVID pandemic, certainly here across Europe at the moment. And I thought it might be interesting if I could ask each of you to just give a closing remark. And what I would invite you is, what advice would you give to, let's say, somebody who's in your situation, whether you're an entrepreneur, an investor, or somebody who's raising capital for clients right now, in terms of the ability to raise finance right now, and also how to go about doing that. So do you have any tip? Do you have any advice? Do you have any thoughts about capital raising in the age of COVID right now, based on your experience? I know that some of you are actually in the market right now and have had success in different ways, and I'd be curious on that. So whoever would like to go first, perhaps Maurits, would you like to or Melissa, please, any hot tips you've got for anyone out there who's thinking about raising investment right now? I'm sure would be eagerly anticipated.
Yeah, no, so it's not going to be easy, so I won't kind of sugarcoat it, but I think that there's two opportunities. Number one, and I think this has been said before, but 100% true for us, it was a year that made us become leaner, become more efficient, and launch digital products that we had been waiting to do. And we've heard that, across the board. For entrepreneurs who have survived this, that you lean up, you cut costs, you look back at it 6 months later and say, I can't believe we're even going to spend that much money on that. So you really kind of make your business down to the essentials, and you launch things that are going to be opportunistic, which is really emphasizing products and services that support people while they're trying to social distance, while they're, maybe when they've lost a job, maybe when they're going through the things we know are happening. I think another thing for me, and I think one thing I might not have quite brought up in this dynamic is, even though we've raised across the spectrum for a couple of years, last year, the one before, I was like, we've graduated from grants, it's time for investment, and I just focused on investors. We've crossed that valley, we're out of it. And I think this year, I think another piece of advice is, even though it's a great time to innovate and it's a great time to launch new digital products, at the same time, some of the things that were broken before COVID-19, I mean, those cracks are even more exposed right now. So in Kenya, there's no functional social safety net for people who are not formally employed. That means 2/3 of this country is struggling right now. People are spending less, they're earning less, they're eating less. And so you can't always sort of innovate your way out of these like deeply, tangible issues. And so this year I just kind of went right back to that full spectrum and said, we need support, we need help. And that message was received better than I thought, despite the fact that we're a business, when you're really kind of in the trenches, it was okay for us to ask for help. And we even had an example of an investor who had actually passed on an investment about 1.5 years ago, just give us a grant, because I'd been staying in touch, they'd been following our work. That it was a not-for-profit fund, so they were able to be a bit more nimble with how they were deploying capital. So I thought that was something that other people could do as well, use those networks and make an ask.
Fully agree. I think now is the time to call in chips with previous investors and people who supported you before, and we're seeing a lot of our fellows who are doing that, as and the goodwill is there. Maurits, as an investor, any advice that you might give in this environment right now? What are your thoughts?
Well, I mean, in the first months of the pandemic, it felt like the market completely dried up and the stock market tanked, and then after quantitative easing and people got a little bit more used to the situation and they looked at the old tax solutions, everything like that, it seems like this market has come back in a big way. And there's a lot more focus on impact now. Now people see all these problems coming to the surface. So I actually think that the time to ask and to ask for money and to invest is actually quite good at the moment.
Quite good. Okay, that's very encouraging to hear. Marcus, final word to you. How are you advising clients right now? What is your read on the situation, and any tips or advice that you might offer to anyone about the environment right now?
Yeah, sure. So I think our main advice would really be to go out and test the water and try it, but also to stay flexible. So if you're now looking for a 2 or 3 million raise, maybe also consider what would happen if you only raise 1 or 1.5 million, because I think due to COVID, people are still, let's say, cautious. And it really, let's say, depends on whether you can get sufficient traction. And for the investors, I would say, let's say, just give it a try and get active, because we still see too many actors waiting at the sidelines that look at the interesting concept of impact investing in social enterprises, but are not active in the field. I think we also need more role models on the investor side that actually get engaged with great social entrepreneurs to scale their impact.
And do you see that the same for philanthropy as well as for investors, or do you see a differentiation in those groups?
Well, I would say that for the level of activity is potentially on the philanthropic side or already more established than on the investor side. And regarding the giving, I think it really depends on the individuals. I think we saw that many philanthropic givers were more focused on portfolio, let's say, organizations due to COVID times, maybe a bit less active in for new activities. But I think apart from that, I think that being flexible and patient potentially applicable for both types of financiers.
Great, thank you so much. Well, we've reached our hour, so I just think it just remains for me to thank our host, Alex de la Torre, and our tremendous panel on a really terrific discussion, to Melissa Menke, to Moritz Schutten, and to Marcus Freiburg. Thank you so much for your experience, your wisdom and your insights. I'm sure you're going to be very actively quoted on Swapcard after this, and from many of our participants who would be very interested in what you said. Speaking from my perspective at Ashoka, interestingly, this has actually been a remarkably strong time for a number of fellows who've been able to raise investment. And so my tip for the audience would be, absolutely do not think that the markets are closed for investment right now just because we are in a pandemic. For the right kind of opportunities, it is absolutely open. And it has I've never seen an environment where it's been so possible to raise across the spectrum. So don't limit yourself to just impact investment or just philanthropy. I think there's an opportunity here to be really creative in thinking about different ways of investing and raising capital. And philanthropists and investors and impact investors have never been more willing to reach across the boundaries and collaborate and work together. So whether you're an investor or whether you're an entrepreneur, I encourage those conversations. I hope you've had some interesting ones in the course of the ACMS, and will do. And and our panelists have very much enjoyed this. So on behalf of all of us, thank you so much to everyone who joined us today. And I'll hand back to Alex now to close up this session. Thank you to all.
Thanks, Mark, for the great moderation.
Thank you.
Thank you.
Thanks, Mar. Thanks, everyone. And thanks to the audience for joining this session.